company or sell a company, how would you try to understand the price? What would you look at? Would you look at what the company owns, equipment, property? Would you look at the market? How would you try to understand the price of a company or the value of a company? What would you try to understand? If I told you my company is worth 1 million euros, and you said, okay, professor, I want to buy your company for 1 million euros. Show me the value. What would you ask me to show you? Price. So how do you'd say, professor, how do I know you're professor, the value of your company should be reduced. What if I own a lot of equipment? I own a lot of very expensive equipment. That affects the value. If I have a patent or intellectual property, that could be valuable, right? Okay. So this is the idea of the things that most people, when they buy and sell a company, when they decide on a merger, what we're going to look at is what are the things that we have to evaluate and understand to buy a company.
But I think that if I can't buy the credit, the value of the company is not less. There are some benefits.
Yeah,
Because,
sure.
when I buy something, you have to sell me without that.
Yeah, sure,
So the
sure.
value is the same.
Lisa,
Yeah.
isn't it the EBITDA value?
We're going to talk about the the earnings before debt and in income. We're going to talk about the EDEBIT today. So exactly, that's one of the value that's one of the ways we can, the EBITDA is one of the ways we value. Absolutely. But there's some other ways depending on, yeah.
Yeah. And then to give a value of to a company, it depends on the sector.
Yeah, absolutely. Great point. So how you would evaluate a tech company is maybe different from a manufacturing company. And Filippo mentioned the EBITDA, EBITDA is a valuation method that we're going to talk about to understand the value of a company. We use more than one valuation tool, as we're going to look at today. Another thing that I want to say at the beginning when we think about valuation is that valuation is both financial and non-financial. Okay, so what does that mean? The financial value is the profit and loss, the income statement, the very concrete things that you can look at and say, all right, this is very concrete value. Those are the financial considerations. But in mergers and acquisitions, often investors also put value on the non-financial factors. And what are those? The non-financial factors could be, this is a really good market to be in for a company. You think, all right, this is a tech company in a really strategic market. I can't put a value on the market, but I know it's a hot market. It's a good market. I'm going to put value on that for purposes of buying the company. These are great clients. This company serves Amazon, Samsung, and I say, okay, these are non-financial factors that I'm gonna add value to my price. The company has really talented engineers or management. And so I say, that's a non-financial consideration. So all of these are non-financial reasons that I will put a value on the company. And on the other side too, I'd say this company is a great company. It's profitable, but its product is going to be obsolete in 2 years because it's going to be replaced by the next generation. So I say, it's not a very valuable company for that reason, even though the financial evidence, the financial support means it's very profitable. So as we think about valuing a company, it's important that we have to consider both financial and think is a fair price for our company. So as we kind of put this in the point of view of a merger or an acquisition, say we're the company that is the buyer. Okay, we're buying a company. In order to make a decision about the price and how we're going to buy the company, we have to understand and rely on these different methods of valuation in order to, how do we negotiate in an M&A? And so one of the ways that you negotiate is when you do your valuation, you come up with information and say, okay, you have a lot of debt, and for that reason, I want to have a better price. Or you discover they have something even more valuable and you're willing to pay more. So the valuation methods are really critical because they help us negotiate the price. And finally, another reason why, or to investors to finance the transaction. Like this morning, Leonardo, you could have been giving a presentation to investors. And so about this M&A, and you would have to explain to the investors why you want them to give to buy the company. You would say, based on our valuation in 5 years, the way that you present that is by to buy the company. And the same applies if you're a seller. You're the company that's selling the company. You need to know what your company's worth. And so this is why, it has, as you see in this particular slide, I've listed them. Evaluation has many important specific functions in an M&A transaction. Determines the price. It also, if you were thinking of buying a company, you would want to understand what kind of risk is involved. Is this company have a lot of debt, a lot of obligations? Your valuation will show the potential risks. If you're negotiating with shareholders, if you're involved in a tender offer, it will help you in negotiations not only with the other company but with their shareholders. Also, we're not going to really focus a lot on tax in this course, but I'm going to kind of identify the issues, but with accounting and tax, it's important to know how you valued your company because in a merger, you could have additional tax liabilities. If the company you buy has big tax obligations, once you buy them, you could assume those tax liabilities. So it's important for us to understand how this valuation works. So all of this is really, really important. This is why we kind of start our journey through the world of M&A really with valuation. We have to, at the first step of the process, how much will it take for us to buy this company? How much can we sell the company for? And so now, one by one, there are about 4 or 5 different approaches to valuation that I want to look at with you guys together. And one of them, Filippo already talked about, the EBITDA that we'll talk about. But the first one that we use is called the enterprise value, or the EV. And so the enterprise value is a very common tool that we use when we want to have an understanding of the company. And basically what the enterprise, or the EV, it's a financial data point that is intended to represent the total value of a company, including its debt and its equity. So its assets and its liability. And so in general, how do we understand the enterprise value? The enterprise value, basically, we take all of the company's market capitalization, so it work. And then we consider its total debt. Okay. If it has interest obligations, stock. So basically, we subtract total assets from total liabilities, and we come up with an enterprise value. And so the way that we kind of start with the EV, or the enterprise value, we think of it as the takeover price. What will it cost? Like if you wanted to come up with the enterprise value of, say, Amazon, we would look at Amazon's market capitalization, total stock issued, outstanding value. We would understand its market capitalization. Then we would try to understand what the company's debts were, its liabilities, and we would come up with a number of, we call this the takeover value. What would it take to buy this company? And so basically, we use the enterprise value as kind of the beginning point to understand the total value of the company together. The enterprise value is not used alone in an M&A. It would be probably the first step where you'd say, okay, Okay.
Uma fala.
Okay. Filippo, we're gonna use the iPad to connect.
Okay.
For some reason, I don't know why it keeps doing this. Says the connection is unstable. And maybe we can put his so we can see it.
And to ask you to accept the
Okay. Okay.
you wrote the host right now, right?
Yeah, should I end the?
No.
Who's the host?
Oh, Filippo is the host.
Yeah. Hmm. I have Filippo make me the host or no? Okay, now you're on, okay. So you'll record from the laptop then, or do you want me to continue to record? Okay. Okay,
All right.
okay. Adesso?
Yes, sorry.
Okay, no, no, vabbè. I leave the meeting. Assign a new host. I would, okay.
Okay, cool.
Okay.
Now it's good for you. You can keep the presentation.
Uh-huh,
The microphone is still on the iPad.
Okay,
It's
okay.
quite good.
okay.
You can even leave the position if you want it, just to be.
Okay.
near. Yeah, but anyway, it's
Okay.
fine. Filippo, you can hear us?
Filippo, you can hear?
Yeah.
Okay, excellent. You hear me okay?
Yeah.
Okay, perfect, perfect.
You can even see the slides.
Yeah.
Okay,
Perfect. Okay,
excellent.
cool. Thank you, Filippo.
All right. Okay, a little coffee break. We're back. We're back. This is, all right. No, just to the screen.
Ha fatto lei, io poi vado e basta.
No, no, so bad. Okay, you know what? This is a teachable moment, as we say. You know why this is a teachable moment? Is that in business, sometimes if you're giving a presentation or you're in a meeting and your technology fails and Luca's not around to save you, this is this happens, and so you have to kind of manage, so we think about this as a teachable moment where we manage through the challenge. So thank you for your patience in working through this. Hopefully this will work. So we talked about the enterprise value, the kind of the starting point. But now we're looking at another way that we can begin to understand the value of a company through market capitalization. And so we know market capitalization, or we call it market cap. It's, what is it? It's, you hear a financial report and reporters are talking about Wall Street or this, they say the market cap of this company. And basically it's the total value of a company's outstanding shares of stock. So if I have a market cap of 10 million euros, that means I have 10 million total outstanding shares of stock. And it's calculated by, we multiply the current market price of a company's stock. So if the current price of a stock is 100 euros, we say 100 euros and we've issued 1,000 shares. We multiply the number of shares by the current market price. And that gives us a market cap, or a market capitalization. So what does that mean? So if you're a public company and say your stock price has gone down because the market has gone down. Take Lehman Brothers, for example. Right after Lehman Brothers, the price of a lot of stocks went down because of the global markets. So a company loses market capitalization when the stock goes down, because say they have 1,000 shares and 2 weeks ago, the share price was 100 euros and now the share price is 70, my market capitalization has gotten smaller. On the other side, when the economy is growing and the markets are in a growth mode, your market capitalization will increase when your share price increases or your stock prices. So often investors and analysts that are looking at a potential deal are going to want to understand market capitalization, because we're trying to understand the value of the company. But what are the limitations? So market capitalization is a good starting point, a good tool to say, okay, at the beginning, this is the value of the market cap. But I can't really rely on it alone in order to understand the price of the company. Why is that? Because market capitalization doesn't account for a company's debts and liabilities. It's just the stock price, okay? So you'd say, based on the market cap, I'm gonna spend, 2 million to buy this company. And I'd say, Sophia, that's great. You did a really good job of doing the market cap analysis, but what about the debts and liabilities? And this is why we can't really rely on it alone. We have to use it with other tools to understand the market value, the actual value of a company. And so now we arrive at another one that Filippo had talked about earlier, which we call EBITDA. EBITDA, which is basically the acronym that stands for earnings before interest, taxes, depreciation, and amortization, okay? And so we want to understand what are our earnings before all of these things are taken out, interest, taxes, and so on. And so this is it's important to kind of understand the concept of EBITDA, because it's used in order to understand corporate profitability, okay? And so we calculate this by, we understand what are our earnings, and then we add in interest, tax, depreciation, amortization expenses to our net income, okay? And so this is another way that we can look at a company's profitability, because it lets an investor understand what corporate profitability is net of your expenses, okay, that are dependent on financing, tax strategy, and so on. It gives you a measurement of what could my corporate profitability be if I manage the company better? Or what is it before we get to all of these other things that, so we're looking at a net calculation. So EBITDA is widely used, but it is criticized sometimes by investors because it doesn't include the costs of capital. In other words, we're going to look at it after the break, the cost of capital, which is your investment today. Okay, if I'm paying $1 million for a company today, I need to understand what the future earnings potential would be, the cost of capital in the future. And so sometimes the EBITDA calculation is criticized because it doesn't include, our capital costs in the present or helping us understand what the future value of a company can be. But it's an important metric that gives us another look at a company's profitability. So the next one we're going to just kind of understand, and we'll look at an example, is what we call price to earnings. Okay, so the P to E, or the price to earnings, is a valuation that we look at the company's share price to its earnings price. Okay, so this is a ratio for valuing a company that we're going to measure a company's current share price to its earnings per share. Okay, so it helps us, and this is an important valuation that we're going to want to look at, because we have to understand what the price is of the share is that it's trading at, but what are the earnings? How much is the company earning for each share? Okay, and the PE ratio is important because it tells us whether our company is overvalued or undervalued. Remember in the previous class when we looked at the RJ Reynolds merger with Nabisco, it was a candidate for a takeover because investors looked at Nabisco and RJ Reynolds, looked at this company as undervalued and poorly managed. So if you have a high P&E ratio, for example, it means that the stock is either overvalued or investors are expecting high growth in the future. If the profit to equity ratio for a company is low, it means the opposite, that it could be undervalued. So the profit to equity ratio is really important. If we look at this with market capitalization, for example, it helps us understand if the company is overvalued or undervalued, which is very important, because if it's an undervalued company, of course, that makes it more attractive for an investor and for somebody to buy it. So let's look at example, just a quick example to kind of help you understand this. And this slide gives us the profit to equity, simple calculation. If I can do it, I'm a lawyer, lawyers don't do math, but if I can understand this, anybody can understand this. So this is our example. We look at the formula that we have here, where we have the profit to equity ratio formula, where we have price per earning divided by earnings per share. And so we look at Walmart, which is a big American, it's kind of like an Aldi, it's a big American company. Their stock in 2021, the stock price closed at $139.55 per share. Walmart's earnings per share in 2021 was $4.75. So for each share, they were earning an additional $4.75. So we do the basic calculation, which is we take the price per share that it's being traded at, 139, over earnings, $4.78, and we come up with a ratio of 29.38 or 30. Okay, and here we can understand if it's a low ratio or a high ratio to understand if the stock is undervalued or overvalued. So this is basically how the calculation works. And so, we go to, from profit to equity, we have another way we can look at this, profit to sales. So the profit to sales operates in a similar way, but it's a ratio where the valuation that compares the company's stock price to its revenue. Okay, so it works in the same way as profit to equity, but now we're measuring it slightly differently, where we're looking at profit to revenue. And the profit to sales ratio is basically, it shows how much investors are willing to pay per dollar or per euro or per stock. It's just another way to kind of understand the company's valuation. If the profit to sales ratio is low, it indicates that the stock is probably undervalued. Okay, if the ratio is high, it means that the stock is probably overvalued. So you're looking at these companies and you're gonna use these different tools to kind of, maybe your PE ratio tells you that the company's overvalued. And we say, okay, we can do the profit to sales ratio as a check and say, yeah, this also says it's overvalued. Or if it comes up with a different answer, then you have an indication that I'm gonna really have to, you know, do a lot of work to understand the true value of a company. So the basic calculation is the same. We divide the stock price by the sales per share, and we'll look at an example in just a minute. But the limitation of this particular metric is that it doesn't take into account whether a company is going to either makes earnings or will make earnings in the future, because we're not focused on earnings like we were in the P to E. We're just looking at revenues, total revenues. So the limitation to the profit to sales is it doesn't take into account either present or future earnings. And so we look at basically this ratio here where we have the calculation, and we see on this slide the three companies, and we've done our calculation profit to sales, and we can see that in the ratio is for company A is lower. Should we stop?
No, just one sec.
Yeah.
So I had a brief chat.
Yes.
Lucrezia is from the same group, like Andrea, Silvia, and Michaela. She was same class.
Okay.
She's staying today, but
Excellent.
she's part of the first year.
Okay.
In the meantime, we're going to be giving her the times, the schedule,
Fantastic.
so she can merge into the group.
Perfect.
The first 2 months, she can be recuperating that next year.
Perfect.
So the first 2 subjects.
Very good.
She may join into here for 1 week, 2 weeks, 3 weeks,
Excellent.
whatever. And once she's settled, she may want to enroll. And in the meantime, I will talk to her about it.
Okay, fantastic.
So, but today, as she's here, she may ask me some questions.
Yeah.
I have a meeting and I have to flee, but I will be back.
Okay.
So you're leaving like
I'm here all day.
all day. So
I'll leave it about
once
4.
back,
Yeah.
we can sit and
Sure. Yeah.
or so recap.
Yeah, grazie, benvenuto. It's very nice to have you. This will give you an understanding of
Right.
kind of how we teach.
So I see you later.
Yeah, we'll talk later. We're very happy to have you. So please be comfortable, ask questions, but we're very, very collaborative in our classroom. And so today we are talking about when companies buy and sell each other. And we're talking about the ways that we can value a company. If we're selling a company, for example, I want to sell you my company. How do I understand how my company's worth? If you want to buy my company, you need to understand what the market value or the true value is. And so we're kind of going through the different ways that we can value a company and the tools that business people and investors use. So in this example, where we're looking at just, profit to sales, total revenue, we see 3 companies, And company A, if we've done the calculation, has a low price to sales ratio. Company B slightly higher, and then company C has a higher one. So this helps us understand basically if it's low, it means it's probably undervalued. So we'd look at this and we'd say, according to profit to sales, it looks like, you know, company A is undervalued. We say, okay, this is very good. On the other hand, on the other side, we look at C, we say, of the three, say for example, we are thinking of buying one of these three companies is on our list. And we've done our profit to sales calculation. And we say, of these three, it looks like company A might present the best value because their stock is undervalued relative to the other two. That's the information that the profit to sales calculation gives us. But as I've said, it's limited. We have to use it with other tools because it doesn't tell us what if this company doesn't have the potential to earn in the future. So we need to use other tools with this, but this is how this works. And then finally, I want to talk about, so we have kind of these kind of 5 basic tools that help us understand value. We have the enterprise value, market capitalization to understand where the company is, price to earnings, price to sales. So we start at this point, we do these basic calculations to understand, okay, this gives me an idea of what my value is. Now I have to kind of make a more precise understanding of my value because, okay, we're working together and Sophia, you say, okay, professor, let's focus on company A. Okay, great. So now we sit down and we say, okay, in order to make our valuation more precise, we have to understand the process. We have to follow a process to confirm or make our valuation more precise. And so this is where it gets a little interesting in the space of a merger, because I have to consider both the financial and the non-financial information together. And the other thing, and we talked about this at the beginning, I think Leonardo made the point that it depends on the type of company that we are trying to value. That will help inform what method we decide to use, because if it's a manufacturing company, we're going to use a very traditional valuation, because we can say you own the building, you own the machines, you own this. It's very easy. But if it's a tech company that has a lot of talent, a lot of patents, a lot of intellectual property, we're going to be using non-financial factors in order to understand the true value of the company. So this is the process that we have to understand.
Era Michelangelo Venti, no?
Sì, Michelangelo Venti. Sì. So we have these basic tools. Now we have to kind of understand what is our process. So in the process of conducting evaluation, the first thing we're going to do is we're going to do a financial analysis. We're going to look at all of the financial metrics, the performance of the company. We're going to say, okay, what are the synergies? We're going to maybe look at market comparables. We're going to consider the non-financial factors. And then after we gather all of this information, we're going to combine all of the valuations that we've used in order to arrive at a final understanding. So, yeah.
Was start with the part 5? We can do a little break.
Yeah, let me see. Let us, you want to take your break now? we lost some time. Can we go for like 5 more minutes?
Yes.
And then we'll take, so it's 11:20 now. If we go to 11:30, we'll stop. And then we'll come back and, you guys can set up to do your presentation.
Okay.
But I'll find, let me go till about 7 minutes and we'll take our break. So comparable, the CCA, so the first thing you're gonna do now that you've started this process of understanding the value of the company, it's called a comparable company analysis, or a CCA. And it's basically, you think of it in terms of, when you wanna buy a house, for example, the first thing you do is, or an apartment, you say, okay, I wanna buy an apartment in Milano, in Isola, I want a trilocale, and this is the square, the dimensions. The first thing my real estate broker will tell me is, say, Lisa, in this zone, a house that was the same size in the same zone sold for this amount of money. So the comparable company analysis is basically the same thing. You're going to basically go out and you're going to find a comparable company. Say you want to buy this company, this software company, and it's 50 employees, it operates in these markets. So the first thing you do is you go out and you try to find a comparable company of the same size, in terms of growth, in terms of market, and you say, okay, what is the comparable? How much is the comparable company worth? Okay, and what we do with this valuation is interesting, is that we make an assumption when we do the comparable company analysis. We assume that similar companies will have the same enterprise value and the same EBITDA. And that's not always true, but for the assumption for the comparable, we assume that a comparable company has the same internal financial metrics. It may or may not be true, but the comparable company analysis will be one that you want to start with. It's limited because, for this reason, you can't rely on the comparable company analysis alone, because, as I said, you could have two companies of the same size, but one is better managed, one has better clients, higher revenue stream. So the assumption that just because they're the same size, they're going to have the same financial metrics isn't always true. And so if you rely on the comparable company analysis alone, you may not, and you probably will not, have an accurate valuation. But this is what you're going to test. You're testing all these out. And so how do we compare? We're going to take a look at this in the next slide, and then we're going to take a break, because we're going to walk through a basic CCA, because it's easy to do and it gives you good information. So say you want to understand the value of a publicly traded company, okay? So the first thing you do with CCA is you identify a group of similar public companies, size, market cap, industry, okay? That's the first thing you do. And we call this usually the peer group, the group of similar companies. Then we try to collect the financial data if we can. Then we do a calculation of the, we use the profit to equity, profit to revenue, profit to sales. And then we compare all of these metrics from the peer group to our target company, and basically allows us to come up with a basic CCA analysis. So this slide, as you have, this gives you an example. Here you have companies that you'd have Amazon, for example. Here's your peer group: Amazon, Oracle, Apple, Dell. These are all your, basically your peer group. And if you wanted to do a comparison with Microsoft, this would show you your CCA. So we look, we say, okay, what is their market capitalization? And we see all of the market cap here. We see the total enterprise value, which we've calculated for all of these companies in the peer group. And then we put Microsoft is at the very bottom. So we could see, how does Microsoft compare to companies in its peer group? And then we have the EBITDA we've calculated. And we have the total revenue or profit to sales. And so here we have a comparison of Microsoft with companies that it's in its peer group. And what we arrive at is we clearly see that Microsoft is, in order to buy Microsoft, when we compare it with companies in its peer group, we have an understanding that the value, it's clearly the best in its, in its market, because compared to companies that would be in its peer group, its financial metrics are much higher. So this gives us an example of what we would have to value if we wanted to take over Microsoft. This gives us a very efficient way to understand the valuation. And this is the basic CCA analysis. And then finally, we'll look at, and then we're gonna break after this. So what are the pros and the cons? This is a really good way to understand the value of your company. You want to understand what are the other companies in the market that are the same size doing, okay? And it's a really good metrics to use because you're using the most current information, public information in the market, like the stock price, the share price, okay? So you're using real-time market information in order to understand the price. It's a very convenient, it's a very easy way to understand value. The peer group is easy to identify. Even with limited financial information, because often a public company has certain information available, but not all. So if you're trying to understand the value of a company without having access to its financial information, this gives you a really good way to understand value. But there are drawbacks or cons or disadvantages to this approach. And by the way, every approach has disadvantages. We want to understand what the limitations are when we use it so that we can use other tools to confirm our analysis. So basically, the disadvantage of CCA is some investors think it relies too much on the market and market information, okay? And basically it assumes that the market price, the share price, is the entire value of the company, where in fact, we want to understand the company may have more value, non-financial value, patents, trademarks, debts that wouldn't necessarily be captured by the market information. And lastly, as we kind of saw when we looked at the Microsoft comparison to its peer group, we have what we call apples to oranges. Every time we do a CCA analysis, we're assuming that we're comparing apples. But really, every company is different. So the limitation to the CCA approach is that Microsoft is an apple and Amazon is an orange and the other, Oracle, is maybe a banana. They're all fruit, but they're all a little different. So it's not really a true comparison of companies. And sometimes the CCA method is limited because it makes an assumption that they're all the same, when in reality, they're a little bit different. But again, the CCA method is helpful because it gives us an understanding as we're trying to work through a process to understand the price. With that, let us go ahead and take our break. When we come back, what I will do is your slides does Filippo have the slides? Okay. if he emails me the slides, because we're using, I won't disconnect with that, I can put them on the board. So over the break, if you email me the slides, then I can display them on my computer. Okay?
Okay.
All right, and we will go ahead and take 11:30, 15 minutes. Okay, very good. Yeah,
Take the, go to the stand.
let him, he can
Okay, cool. Let's back to the presentation.
Mhm.
Tuck.
And Outlook closed.
Filippo, you can see the screen right now.
Io?
Cool.
Filippo, if you send me your
Yeah.
presentation, I can display it on the screen for everybody. Because you're not connected, or can we connect him to the,
To the,
oh, that's 28%. Well,
yeah,
that,
I'm gonna bring the charger right now.
or you can, will this work?
Is the C, yeah, okay, yeah, can work, can work. Cool, thank you.
And then,
Uh,
I sent it.
oh, you did? Okay, okay. Um,
yeah, Outlook sometimes. A couple of minutes.
oh, Lucas,
Okay. I just want to go with ESP.
oh, is that where he's, okay, of course.
Makes sense.
Mhm. Of course.
How's that? Since she's not teaching. Okay.
I'm sure she'd do it.
Yeah.
But I'll definitely help him. Okay. Waiting for it to arrive, Filippo, I'm sorry.
Or he can even share his screen.
If he shares his screen,
Yeah, we can use it.
oh, yeah, okay, and then after he's done, I can plug mine back in.
Exactly.
Okay,
Exactly.
let's try it.
That's right. So let me stop the sharing right here.
Okay. We're coming up with a solution, a different solution that might work.
Sure. Okay. Filippo, if you want, you can even share your screen right here.
If you share your screen right now with the presentation,
Yeah.
we can plug it into the screen.
Super.
Mhm.
Or we can still try.
Oh, yeah,
I don't know if it's working.
yeah, sure. Wow.
Cool.
Okay,
Perfect.
look at that.
Mm,
Oh, here is my guy with me, Tom.
Wow. So this will work out perfect. As soon as everybody gets back, you guys can start.
It's okay.
Yeah, it's fine. Oh, yeah, for today. Yeah, when Stefano gets back, yeah.
But yeah, that is definitely the coolest solution.
That would be, if we could, take a couple, get, visiting students,
Yeah.
especially to join our second year class next year, because that will be like 7. Cool. That would be good for them.
Not bad at all.
Because they're coming out of, universities that they don't want to, one of the things that was interesting, we were talking about, the people from other European schools are saying our students don't want to go abroad or do an exchange where they're sitting in their room following courses online. They want to be in a classroom interacting
Yeah.
with other students.
That makes sense.
Well, think about it, you know, you spend, like, you go from, say you're in Brussels and you go to Madrid or somewhere and
You have to stay on.
you're in this
It's totally
and you're following courses online.
reasonable. It's reasonable, yeah.
Mhm. Are they outside? I'll go get
Yeah, I hope that.
Oh my God. I'll get them. Filippo's lonely. Okay, Filippo, I found them.
Okay.
Okay.
Just
So
a
we've
second.
got, can you hear okay? Are you still there? Oop. Okay, whenever you guys are ready,
Can you hear me now?
I can hear you now, yeah. Okay, your colleagues are back. I've got your PowerPoint on the screen.
Mhm.
So, I understand you three are gonna present this together, so I will turn it over to all of you to tell me about due diligence.
Yeah, can I tell you where we're gonna change so it's clear
Yeah.
for everyone? Yeah, we're gonna change at financial due diligence
Okay,
first time. So, oops, I clicked the wrong thing.
okay,
Sorry, clicked the wrong thing. We will change at financial due diligence, and then we're gonna change again to around human resources diligence.
okay,
Okay.
okay.
Just to make it clear that everyone knows what he or she is doing. I'll start.
Yes, okay. So,
Okay. Then I'll start. We chose for our presentation about the merger and acquisition, talking about due diligence, we chose the merger and acquisition between Facebook and WhatsApp, where Facebook basically bought WhatsApp and then brought it into its Meta group.
mhm.
And our title is Navigating Due Diligence Dynamics and Unveiling the Due Diligence Journey, made by myself, Leonardo and Sofia. We have the index, so this is what we are going to talk about in the presentation. We have the introduction to the acquisition, so a brief overview of what happened. And then we have all an overview of the due diligence, the main types of due diligence here, the impact on the purchase price, and then our conclusion. This is just quick index showing what the presentation is about. Then we have introduction to the acquisition. Okay, so the overview is that Facebook was founded in 2004 by Mark Zuckerberg, and it was launched as a social networking platform for college students in the very beginning. So it wasn't as wide and big as it became over the years, as it grew rapidly to become the world's leading social media platform with billions of users, at least until Instagram got the largest share of the market. And WhatsApp instead was founded in 2009 by Koeman Acton. I guess that's how it's pronounced. And instead, they were focused on providing a simple and secure messaging platform, which is much different from what the concept of Facebook was at the time. And again, this as well quickly gained popularity in reaching millions of users globally, at least. Then we have introduction to the acquisition. So we have the significance of the acquisition, which was a strategic move for Facebook, as its interests were in expanding the reach beyond social media, so beyond the platform that Facebook was in the beginning, but they also wanted to have the messaging part, because Messenger, the internal messaging app to Facebook, was not really getting the market share that WhatsApp had. Reason why Facebook was interested in WhatsApp's dominance in the messaging app market, as you can see the third bullet point there. And then we have the recognition of the growing importance of mobile messaging, because SMS were not used quite as often as WhatsApp was, and WhatsApp then became the leader in messaging platforms online. And we have the impact in the industry, where the acquisition was one of the largest in the tech industry. Indeed, I think it was one of, in three at least, of the largest acquisitions of the last few years. And then we have signaled a shift in focus from traditional social networking to communication platforms, because when WhatsApp became part of the group, Facebook got a major upgrade as well as Instagram, and WhatsApp became the first and only basically platform that people use worldwide when communicating, even for work. Now, many video calls that happen on WhatsApp and not on Zoom if it's something quick. So it's a very quick way to work and to message with and communicate with other people. And of course, it set the stage for a new era in the evolving landscape of tech acquisitions, because it was, as I said before, one of the largest. Then we have the due diligence overview, where we talk about the definition and purpose, where we can state the due diligence is a thorough examination of a company before acquisition. So it's all the evaluation and all the investigation that there is behind a company before actually buying it. Its purpose is to uncover potential risks, liabilities, and opportunities. So it's basically an analysis of the company that you're buying. And the importance in M&A is the fact that it's, of course, a critical step for obvious reasons. It reduces uncertainties and enhances decision-making, as when you have all the information displayed in front of you, you have a much wider view of what you're actually doing and of what you're, and a better ground in order to make decisions. Furthermore, it ensures the buyer gains a comprehensive understanding of the target. So you actually understand the values and limitations of the company you're evaluating. And now we have the financial due diligence.
Okay.
I'm good.
Okay.
And final vacancies are opting. Solely assess WhatsApp finance condition, included explaining finance training, cash flow review, and potential liabilities projects. The content details examination of WhatsApp finance records, verification of actually the finance project by WhatsApp. If finance due diligence report positive, if you call the debt supported a higher value to WhatsApp vice versa, ma Filippo, okay. No. Legal due diligence, the one the objective in WhatsApp acquisition, the objective is of legal diligence of the WhatsApp acquisition was the legal standing and the potential risks associated with WhatsApp. It's including our overview of contacts, ownerships, litigation, regularity, completes, and other legal consideration. Process with WhatsApp acquisition. It's like Facebook would have full explanation of WhatsApp legal documents and arguments. This project until the utility and legal issues that may pose risk to acquisition or impact to the legal staging of WhatsApp. Impact of purchase price in WhatsApp acquisition. Legal due diligence findings could have influence to regulation of the purchase price. And if legal risk were detected, if Facebook might have negotiated admissions to the purchase and the price to account the purchase legal liabilities. It could also to include the integration clauses in the law. And in intellectual property IP vigilance. Their objectives are access the value, security, and potential risk associated by with WhatsApp intellectual property. And the process is examining parents, determining copyrights and trade secrets owned by WhatsApp, and review leasing agreements and potential implement issues.
Very good.
And impact on WhatsApp acquisition, project of impact asset is through the project of WhatsApp value, intellectual property asset, the straight and value of foreign instruments, risk and migration, identity, I resolve the risk that could impact the acquisition, early the likelihood of legal change led to real property. And the assignments of the department are opportunities are exploring that opportunities of relating to WhatsApp intellectual property with the burden acquisition of Facebook and it is by that you can hand over the business view. And the human resource.
If you want, we can change. I think. Wait, sorry. Let me do this. So you can. We have the last part left, so if you want, you can change.
Okay.
Yes.
Yeah. Sorry. Okay.
Okay.
Objective, understand the workforce and potential human resources, related risk associated with the WhatsApp process, review employee the contracts, benefits, and human resource policies, assess the organizational structure, and identify potential human resource issues. Organizational due diligence. Organizational due diligence in WhatsApp acquisition, efficient integration, understand how WhatsApp's organizational structure aligns with Facebook's, identify potential areas for streamlining process and achieving operational efficiency.
Okay.
Cultural alignment, assess how the organizational culture of WhatsApp align with the Facebook, identify potential cultural challenges and opportunities for integration, operational synergy, identify potential operational synergy between WhatsApp and Facebook, explore opportunities for collaboration and resource optimization. Impact on purchase price, financial insight and valuation, financial due diligence in the WhatsApp acquisition, risk and the potential adjustment to the purchase price, positive financial findings supported higher valuation for WhatsApp, legal and IT consideration, legal due diligence, identifying legal risk specific to WhatsApp, influencing negotiable terms, intellectual property due diligence impacted the purchase price based on the strength and risk associated with WhatsApp intellectual property, cultural and organizational integration, due diligence on cultural and organizational aspects, alignment with the Facebook strategy, cumulative due diligence findings, influence the negotiation terms, insurance, fair and informed purchase price, reflective on the identified risk and opportunities in integrating WhatsApp into Facebook. In conclusion, the due diligence process played a pivotal role in the WhatsApp acquisition by Facebook by uncovering financial, legal, intellectual, cultural, and organizational insight. The
comprehensive
due diligence approach contributed to informed decision making and negotiable strategy. The impact on the purchase price reflects the throughout the evaluation of risk and opportunities, ensuring well-informed and fair evaluation for the successful integration of WhatsApp into the Facebook ecosystem.
Excellent, outstanding. Let me ask you guys a couple of questions. Filippo, can you hear me?
Yeah.
Okay, so really interesting analysis. Let me, the first question, and you both can answer if you want, but it's to the group. In your opinion, did the due diligence review in this case, did it confirm the value, or what was the result? Did it tell Meta that, bye, thank you, we'll see you again. Did it tell Meta that they were paying the correct price, or did they use it to negotiate a different price? How did it impact the value? Did Meta say after this due diligence, this is a valuable company, or did it find anything that led them to
I
say?
think that before the due diligence, the price of company is more or less fine. And due diligence is only a formal thing to analyze the
Confirm the price?
Yes, confirm the
Okay,
price.
okay, very good, very good.
But the price is stipulated before.
Okay, so in this particular case, Meta confirmed that WhatsApp was a valuable company through this due diligence process.
Yeah.
Okay. Filippo, same question to you. What do you think? Did the due diligence process work in this case? Was the value?
Yeah, it definitely worked. It was extremely positive because it outlined all the possible aspects that made WhatsApp be bought by Facebook group. And
Okay.
also it increased its value when it was merged, when it was bought by Facebook. Basically, when it entered the group, it had a higher value due to all the aspects that they had examined, as we wrote it here somewhere. I can't remember where, but
Yeah, exactly. So what's interesting is we're talking about valuation today, and the reason why I like taking these two subjects together is you kind of see the relationship between how we value companies at the beginning of the process, and then as we go through valuation and due diligence, we either confirm or we discover information that allows us to negotiate. Sophia, I really liked your part of the presentation. For example, we talked about legal due diligence and intellectual property. For example, if in this case, they were doing due diligence and it was discovered that there was a very expensive lawsuit, a very expensive legal case, would that have impacted the value? Could that have been used to say, we have to negotiate a different price? Because if due diligence, if you discovered that they had liabilities, legal liabilities, that would have affected the valuation, right?
yeah, of course.
And then, of course, intellectual property is another one. I'm glad you covered that, because especially now when companies are sold, there is always trade secret IP. And what if you discover that you're buying my company and I say, Sophia, I have the patent and the trademark. And you say, Professor, give me your proof. And I say, I guess I didn't really have my patent after all. So now you've discovered that I don't really have IP. And what happens to the valuation at that point? It goes down, right? Okay, so really good. So last question. Are these two companies compatible? Were these two companies that had synergies, in your opinion? Was this a good merger?
Yeah, definitely.
Okay, okay. Really interesting. I like that you chose this case study because it's a good one, because we're gonna look at in future classes, mergers that failed, mergers that seem to be good ideas, but because they were not compatible, they didn't really have the synergies, they ended up failing. So, excellent job. I really like the way you guys put this together and working through it as a group. I really liked it. And if, just as a reminder, Filippo, since you have the slides, we're putting everything in Google Classroom. So if you could post the slides for this in Google Classroom, just go on and make sure to do your slide from last class too, your slide.
Yeah,
Okay.
okay.
Perfect, well done. All right, let's go ahead and finish the lecture. Let me put my screen back on, and then Filippo, I'll make sure you can see. Okay. Go back to. Okay, so now okay, and okay, so let's kind of go back to the methods of valuation, and you kind of drawing on your due diligence analysis, you see that all of a sudden you're trying to confirm value. This is the step in the process where we're trying to understand value. And so we looked, before we took the break, we were talking about the comparable company analysis, and it's helpful. It's based on market information, public information, but we also have another method that we use to try to understand the value of the company, and it's called the precedent transaction analysis, or PTA. And this is a method of valuation that looks at, similar to the comparable company analysis, this is a method that looks at similar M&A transactions from the past. Okay, so in a PTA, what we're going to use, we're going to take the past performance results of a company to help us understand a company's value. And it's a tool that we use when we want to have what we call a baseline, or a foundation of the value of a company. And we usually use this in relationship with other tools. So if we were doing a PTA analysis, what we would do first is similar to our comparables. We would identify a group, a peer group, of similar M&A transactions from the past. So if we're looking at a computer company, a medium-sized computer company that was acquired by a bigger company, we would do our research to try to find 3 or 4 similar transactions where companies were bought from the past. And then we would collect the financial data that was available with our peer group. And then we would apply the multiples from the peer group to our target in order to understand what the estimated value would be. And of course, you know, we would make adjustments, but the PTA process is essentially just gathering, like the comparable company that's looking at current metrics, we're looking at recent past metrics and recent transactions in order to understand the value of a company. So the next method is an important one. We call it the discounted cash flow. And this is really important because it pertains to how we look at the cost of capital. We want to always do a DCF, or a discounted cash flow evaluation, if we're thinking of buying or selling a company. And this basically means this is a method that determines the valuation of a company by its future earnings, its future cash flow. So the issue is this, and you know, you kind of look at it. I have money sitting on my table today, but what I want to understand is if I expect to earn money in the future, in 10 years, I expect to earn the same amount of money that's sitting on the table. But there's the time value of money. We have to discount it into present value terms because the future value is different from the present value. So this is an evaluation that puts an expectation of what we're going to earn in the future into present value. So it's a way that we can take anticipated future earnings and discount them into an amount that is present value. And so this is a way, because we're paying for a company today. And so the discounted cash flow allows us to understand what our future cash flow is in present day values. And so why is this valuation important? Because if it's higher, if the discounted cash flow is higher than the current cost of the investment or the amount that we're going to buy, then obviously this is a promising opportunity because it means that the future return is going to be profitable. However, if it's lower, that means our investment may not be good. The disadvantage of, or the limitation of the discounted cash flow method is that if we are inaccurate in our projection of future cash flow, if we say today this company is going to make 10 million next year, and I use 10 million as the basis to make my discounted cash flow calculation, if my original projection is wrong, I assume 10 million, but the company only makes 5, then this discounted cash flow calculation may not give me information to make a good decision for my investment. But it's a valuation method that allows us to understand the future value of a company. So we kind of look a little bit more at the basic steps to doing a discounted cash flow. And so the first thing that we do is we forecast the company's future cash flows. And usually if you're doing a discounted cash flow, you do it for 5 years or 10 years. Say we have a company and we say, okay, next year we project it will make 5 million, in year 2, 7, year 3, year 4. So you do your projection. And then you have to use what we call a discount rate. And there's this, what we call the weighted average cost of capital, what we're going to get to, but we apply a rate that we use to our projection. And then we calculate using the projection with our discount rate. We can do a calculation that will allow us to translate our projection into present value. And so after we do the calculation, then in the final step, we subtract the net debt to arrive at the equity value. So let's look at one more slide that shows us how we do this calculation. So DCF on this represents discounted cash flow. And so here's our calculation. Our cash flow for year 1, year 2, year 3, for example. And then below we have our discount rate, and we do the calculations, and we can arrive at a figure in present value that gives us an understanding of the discounted cash flow. Again, this is the formula and another way that we can understand in present day euros or dollars what the value of a company is if we want to capture and include what their cash flow will be for future years. There's what we call an asset-based valuation that we use. And this is a very simple, straightforward evaluation that we use. It's basically what are the company's assets less its liabilities. So if we were buying a factory that had a lot of tangible assets, like a factory, a car company that owns a physical plant, that owns equipment, has inventory. We would do, if it's a traditional company, we would do an ABV valuation where we would say, what are the total assets versus its liabilities, and we would arrive at an ABV valuation. This is the traditional approach that you would use for a company that has a lot of physical, tangible property. However, if you're trying to buy a company that, say it's an e-commerce company, or a company that doesn't have a lot of tangible, physical equipment assets, this asset-based approach wouldn't be very helpful, because you'd say, okay, what does the company own? Well, we have a lot of computers, we have salary stuff, but the asset-based approach doesn't allow you to understand the value of a technology company or a company that is a professional services company. So this is the approach that you would use for a more traditional company that has a lot of physical or tangible assets. And this is the basic approach. You determine you take all of the assets, all of the things the company owns, the property, the building, we figure out what is its fair market value, and then we subtract all of the debt, the loans, all of the obligations, and we arrive at our asset-based valuation. So this is a pretty simple and straightforward way. And the final method that I want to talk about is what we call liquidation value. This is important because oftentimes in a merger, companies are bought in bankruptcy. In fact, Luca and I were talking on the break. You guys have all heard of the company WeWorks, the big office, huge company. They are now in bankruptcy because of mismanagement and poor financial decision. Lehman Brothers, Leonardo, you did a very good presentation on Lehman Brothers. Lehman Brothers went into bankruptcy after it failed with the subprime mortgage crisis. And so these are companies that investors will go into bankruptcy to buy the companies. And oftentimes you look at the liquidation value of a company, because the company's in failure. What is it going to take to liquidate all the assets to sell? So the liquidation value of a company is the estimated value of a company's assets, assuming that it's in liquidation. It's basically selling off all of its remaining assets. We say, what is the liquidation value? Basically, this is the minimum price for a company. Because if a company's in bankruptcy, you're saying, okay, they're out of business. What do they still own? What is the value of its remaining assets? And that's considered, the liquidation value. And usually it's the minimum value. In a bankruptcy, if there's more, for example, if there's more than one investor that wants to buy WeWorks or another company that's in bankruptcy, then you're going to start at the liquidation value, and then you're going to negotiate from there. But this is the base value. Liquidation analysis isn't commonly used in a traditional merger or acquisition. It's the strategy that you need to be aware of if you're an investor trying to buy a company that has failed, that's gone out of business, that's in bankruptcy. You usually start with the liquidation value. Okay. And then finally, the basic steps in liquidation. So in Lehman Brothers, for example, the first thing you do is say, okay, what are the company's remaining tangible assets and intangible assets? Then you come up with the cost of liquidating the assets. So the company's in bankruptcy, and you have to determine, okay, this is the fair market value of the remaining assets it's owned. But remember, on liquidation value, I have to subtract its debts. You're going to have to hire lawyers to sell to process, so you have to subtract all of the costs associated with liquidating or selling the assets. And of course, the net that you arrive at in this way gives you the liquidation value. So again, this is just something, if the company is in failure or is closed or in bankruptcy, you're gonna want to understand the liquidation process. And then finally, a couple more comments. We're going to end the lecture on talking about the cost of capital, which is really important. The cost of capital is important because we have to look at this if we're buying a company in general. The first thing that we need to understand when a company talks about the cost of capital, I'm a company and I say, okay, I want to buy this new office building because my company's expanding. And so if I do a cost of capital calculation, what I have to do is how much is it going to cost me to buy this new building? And I have to compare this with the minimum amount of return that would be necessary to justify my investment. So if I say I want to buy this new office building because I can put 200 new employees in this building, and by giving 200 employees this space, my revenue is going to increase by this amount. And I say, okay, I can justify the investment because I can not only make back my investment, but I'm earning a return that will justify buying the building. However, if I do my cost of capital and I say I'm spending $1 million and these employees are not going to generate more revenue, I can't justify the investment because the cost of capital is more than what my revenue will be in return. The cost of capital is what tells me whether my investment is justified. So that's the basic concept. Now, if we put this in the context of a merger or an acquisition, we use a cost of capital to understand the discount rate that we use to determine, going back to we were talking about the discounted cash flow approach. We use the cost of capital analysis to determine the rate that we apply in order to say, okay, to understand the profitability of this company, its future earnings will be this. To understand whether I want to buy this company, I do a cost of capital calculation to understand how profitable is this company really going to be in the next 5 or 10 years. So basically, we use a discount rate to determine the present value of future cash. And this is important because the value of a company is based on present day. We're going to pay in present day dollars. So we have to understand basically, what the present value of a company is. So we're going to understand both the future debt and the future equity according to the company's existing structure. So this is what allows us to find the discount rate so we can perform the calculation to understand whether the company is truly going to be profitable in the future. And we call this the WACC, or the weighted average cost of capital. And really, you'll get more of this in financing. I just want to introduce to you the concept because it's important to understand this, how this works in a merger. But basically, the WACC, or the weighted average cost of capital, is basically a ratio that measures the company's financing costs. Okay, so basically, it measures a company's debt and equity proportionally to their percentage of total capital. Okay, so why is this important? Because if our WACC ratio is high, the cost of financing the company is going to be high. It means that we have to support a lot of capital, a lot of debt, a lot of investment interest and so forth. So if it's high, if our WACC ratio is high, it means that our capital needs are high. It means that the investment risk is going to be higher. So this is why investors are concerned about the weighted cost here. So how do we apply the WACC? And again, you know, this isn't going to be a math exercise, but just understanding the theory behind it. We use this in discounted cash flows, for example, as we've already talked about it. The purpose, we're using a ratio to help us understand the present value of future profit, future revenue, future cash flow. So basically, we determine the cost, the cost of equity, we determine the cost of debt, we determine the weights that we apply, and then we come up with a calculation. And the WACC, once we go through this calculation, gives us a rate that we can apply to discount our projection of year 1, year 2, year 3. We come up with this rate that we could use that allows us to understand what we think the value is today. Because if we say, I'm going to sell you my company for this amount of money because in 10 years, it's going to be worth this. And we say, okay, how do I understand and arrive at a price in present day dollars? The WACC is what helps us understand if our investment or the valuation is too risky or weighted appropriately. So this is just introducing the concept at this time. But really, the most important part of this, and just we're almost done, a couple more slides, but this is the time value of money. When you buy a company, you want to understand what is its value in this moment today, but you also have to understand the time value of money, what its future value will be, because you're investing in the company's performance as a future revenue generator, as its profitability. So investors always want to understand the time value of money, which will always be considered in a transaction. And so when we talk about the time value of money, what is it? Basically, it's a concept that the sum of money is worth more today than this money. So if I had 10 euros sitting in front of me today, based on the time value of money, this money is worth more today than 10 euros will be in the future due to, you know, all of the factors that, so have you ever heard your grandmother say, you know, the lira isn't worth what it was worth today if we were still using it. My, you know, grandparents used to say, you know, things used to cost less 20 years ago because the time value of money, that $100 10 years ago was worth more to the people in that period than that same amount of money today. That's the time value of money in its most simple and basic form. But if we're buying companies, we have to understand and we have to have a way to evaluate the time value of money. Because investors, your investor prefers to have the money today instead of, you know, in the future. This is because a sum of money, once it's invested, will grow over time, right? So if it's not invested, the money will erode over time. So the time value of money evaluation is what helps investors make the best investment decisions. I want my money today. And so this is the analysis. So this is just a very simple way to present the time value of money. If we look at this formula, the present value of money is PV. The future value is FV. I in this formulation represents our rate of interest. So if today the rate of interest is 3%, we put that into our calculation. T represents the number of years. N represents the number of compounding periods of interest each year. So, if we have interest that compounds every month, we have 12 interest periods. So this is what allows us to determine the present value of money. So this is the calculation. You will get more of this when you take business accounting, but really, again, for our purposes, what I want you to understand is we always have to consider, if we're talking about future revenue, future profits, future price, investors always want to understand what is the time value of money, what is the present value versus the future value. And this is a formula that helps us understand that. Final, just a couple of comments. The net present value is the final thing that I want to talk about. The net present value is the difference between the present value of cash inflows, okay, the money coming in, and the present value of outflows. Say, if I want to know for a period of 6 months, what is the net present value? I would calculate, in this 6-month period, we spent 1,000 and we took in 2,000. So we separate those to arrive at the net present value. And this helps us understand the value of a project or an investment. And so this, again, allows us to understand whether we are losing money, making money, whether our investment is valuable or it's costing us money. But often, if we're doing a valuation in a merger, we might say, what is the net present value over a specific period of time? That will help us understand if the company is in fact valuable. Final comments on the accounting methods that we use. So again, in financial accounting, you'll look at these more carefully, but for purposes of an M&A, what I want you guys to understand is during a valuation process, we've identified our target, we're the buyer, we have to agree in order to do the transaction now. You and I have to agree that we are going to, basically use the same accounting method so we can understand. If you're using one method and I'm using another, we say, okay, Sophia, you're coming up with, so this is really important. We have to agree once we start the process to close the deal, we have to use the same accounting method. Even though we have two separate companies, we're trying to do the deal, the first thing that has to be, accounted for is the companies have to use one method of calculation. There is a quick history. The FASB is the Financial Accounting Standards Board. FASB is an international accounting board, and they, like the generally accepted, the GAAP, the generally accepted accounting principles, the FASB designates the best practices, the accepted accounting methods that are used in these financial transactions. And really, brief history, in 2001, the FASB had designated a method called purchase accounting for M&As, okay? And by a little bit of background, there was this process that called pooling of interest, which meant that the method for accounting, if you were doing a merger, would be that the two companies would basically pool interest. They would allow their assets and liabilities from the target company, the acquired company, to be booked to the buyer for value. And the only thing this covered was tangible assets. Intangible assets were not covered. The assets and liabilities were simply added together, okay? And they showed up on the balance sheet. This has been changed. now, where we have what we call the purchase, the first change went from this pooling of interest to purchase accounting, which used to be the sole method for M&As, and now from purchase accounting, since 2007, the standard that is used today is called purchase acquisition, which is the method that when you're combining two companies, it's the purchase acquisition method, and this is the one I'm just gonna talk about, and then we're going to wrap up. But today, if you're combining two companies and you have to use the same process, we use the purchase acquisition method, which is an accounting method of reporting the purchase of a company on the balance sheet of the buyer. So I'm the buyer. The method that we're going to use, I bought Sophia's company. I'm going to report the purchase on my company's financial statement. And I'm going to treat the target company that I bought as an investment, rather than just saying, your assets are now my assets, we pool back and forth. The specific approach now is I reflect the purchase on my accounting records as an investment. I don't pool the assets or combine the assets. Instead, the assets are recorded on my books at their fair market value. And basically, this practice increases my fair market value assets because I'm treating it as an investment. The liabilities of the company that I just bought are subtracted from the fair market value of their assets, not my assets. So it comes onto my books as an investment. And so basically, this is a more accurate way to reflect and record the value. So the amount that I pay as the buyer over Sophia's company's assets and liabilities is recorded. The net is recorded on my books. And basically, this is now the generally accepted practice for accounting. Again, this is very technical. I want you guys to be familiar with the different ways that we value companies. In financial accounting, you will have a more detailed look at this. But for now, I want you to understand why do we value companies this way? Why is valuation important? If I have to understand the value of a company, I know that I can't just use one method. I have to look at different ways to capture a company's value. If I'm buying a manufacturing company that has a lot of tangible assets, I'm going to take one approach. If I'm buying a company that doesn't have a lot of tangible assets but has intellectual property and high non-tangible assets, I'm going to use different valuation methods. And so the idea of this class and this lecture was to introduce the different ways that we have to understand the value of a company, okay? So you saw, and especially with your homework assignment on due diligence, you saw that, the importance of valuation and due diligence is that when you understand valuation and then you do due diligence and you discover more information about a company, you can use that to negotiate and come back and say, you know, the valuation that you said was worth this amount of money. We want you to lower your price because our analysis of the profit to equity or profit to sales indicates that your stock is overvalued or the valuation is not as high as we thought. So you can use it in that way as part of your due diligence and your negotiation. So this brings us to the end of where we are for the lecture today on valuation. There's no homework for this week other than to review the slides and the information. Next class, I'm giving everyone a break because we did 2 assignments, recover, review the material. Next week, I am going to hand out homework assignment number 3. I will probably post the homework assignment when I post the slides. I'll post the homework assignment this week. I invite you guys to look at it. It will be a presentation. Again, the value to these presentations, you guys, is it helps you to work on your presentation skills, your soft skills. It gives you an opportunity to explain these concepts, because in business, you will be in a meeting, you will be meeting with investors, you will be meeting with your team. And so this gives you an opportunity to show how well you understand these concepts by explaining the idea. So next class, we are going to take up negotiations, which is a really interesting approach. We're going to look at the different ways that we negotiate if we're trying to buy or sell a company. And then we're going to talk about confidentiality, because once I give you my information for due diligence, I have to make sure that you don't share it outside of our transaction. So we'll talk about that. All right, guys, unless there's any questions, thank you. I apologize for the challenge we had with technology, but hopefully we have a better solution now for the future. Be sure to post the slides from today on our Google Classroom site. I'll offer some comments and return them to you guys, but overall, very good work on the homework assignment. Okay. All right, thank you, everyone. I will see you all next Tuesday. Thank you, Filippo.
Thank you.
Okay, bye-bye. Have a good week, you
Bye-bye.
guys.
Thank you.